Most private banks have beaten street expectations in terms of profits in Q1 FY23, driven by healthy pickup in loan growth, asset quality trending better, and significant decline in credit costs and provisions, even as treasury income was muted. It's worth noting that most of the earnings uplift and price uptick has been in the stocks of large-cap private lenders. Should investors expect the rally to spill over to mid and small-cap banking stocks? In this backdrop, let's analyze DCB Bank. DCB's performance in the recent years has been lackluster. Its asset quality deteriorated sharply, leading to elevated credit costs and weaker profitability levels. Despite the not-so-impressive performance, we are positive on the stock as the bank has multiple levers to improve return ratios over the medium to long term. Management intends to double the balance sheet in the next 3-4 years. Asset quality should improve in FY23 on the back of higher upgrades and recoveries leading to lower credit cost. Collection trends from the segments at the bottom of the pyramid have been very encouraging too. In case of DCB, the overall book is well collateralized, that enhances the recovery chances. And lastly, valuations look very compelling as the stock is trading much below book value. Precisely for this, we see reasonable upside to the stock price, supported by business growth and earnings in FY23. With improvement in macros, Advance's growth has improved 18% in Q1, albeit on a lower base. DCB has established market position in the SME segment, which along with mortgages segment constituted over 50% of the loan book as of June end. Going by the management guidance, loan book is likely to increase by 20 to 25% CAGR over the next 3-4 years. Share of low-cost CASA deposit was at 28.6% as of June end, much lower compared to peers. Net interest margin in Q1 stood at 3.61%. As per management, NIMs are expected to stabilize at 3.65 to 3.75% range. Lower slippages in future will reduce interest reversals and help move margins. DCB Bank saw an increase of 32% YOY in operating costs, which along with lower treasury income pushed cost-to-income ratio to 64% in Q1. Going forward, costs are likely to remain elevated as the bank expands the branch network, adds headcount and invests in technology. However, as the business gains momentum and balance sheet expands, operating leverage will help reduce cost-to-income ratio and cost-to-average assets ratio to 55% and 2.4% respectively over the next 4-5 quarters. FY23 earnings will thus get some support from the improvement in operating efficiency. Meanwhile, DCB's asset quality deteriorated in the past 2 years, with GNPA touching 4.2% as of June end, having increased from 2.5% in March 20. While GNPA declined from the peak of 4.8% in December end, asset quality is vulnerable as a significant portion of the book is under moratorium, indicating high potential stress. Performance of the structured portfolio will be a key factor to monitor as moratorium period ends. That said, recoveries and upgrades have been very strong in the past couple of quarters, and if the trend sustains, GNPA will decline even if slippages remain high. With easing asset quality, credit cost is likely to decline, which will be a key driver for FY23 earnings. DCB's credit cost in FY22 stood at 1.5%, and management expects it to improve 0.5 to 0.6% over a period of time. Going forward, improvement in return ratios for DCB hinges on balance sheet growth, operating leverage, and improvement in asset quality. We see slippages and provisions moderate, driving profitability in the near term. But over the medium term, operating efficiency will be a key profit driver. DCB's stock is currently trading at 0.7 times FY24 estimated book, which is very compelling, and prices in growth as well as asset quality concerns. Substantial valuation re-rating above one-time book is unlikely till the ROA improves above 1% on a sustained basis. However, with multiple positive triggers, the valuation can inch closer to one-time book, which will drive meaningful stock upside in the near term.